But here's what everybody's going to tell me. Yes, Kurt, but that guy making $120,000 a year is now making 80. There's a lot of people I know that are engineers that are working at Home Depot. Right? They lost their jobs. There's something in the economy called creative destruction. Creative destruction is when one industry is destroyed and another one pops up in its place. I mean, you can think about it. Wait, does anybody even look at a phone book anymore? I just go to the internet. Is Blockbuster going to be around anymore? No, they go to Netflix. Creative destruction. Creative destruction takes place, but something interesting happened. I'm at a wedding Friday night in Boulder. A friend of ours' daughter's getting married. He's a software engineer. I knew he just changed jobs. He goes, yeah, he goes, I'm working with this company out of California that does research and stuff into data storage and all this kind of stuff. He said, they can't find any engineers in California. I said, wait a minute, hold it, what'd you say? He goes, no, they can't hire anybody. They can't find the labor they need in Silicon Valley. So they're opening up a branch in Boulder. Oh, that's a big signal. That's a signal that the economy is getting into a next level. When that underemployed starts to go, and what happens when that happens? Wages start to go up. What happens when wages start to go up? More money, chasing fewer goods and services. We'll start to slowly see a trickle of inflation. Okay? It's not going to be a big trickle, but it'll be a slow trickle. I'll give you the reasons for that in a second. I think there's a slide coming up on inflation. Corporate cash, I love this one as well. Here's what's going to happen. Here's the next leg. Corporate cash. U.S. corporations have more cash on hand than they've ever had. Unbelievable amounts of cash. In 2008, who got hurt? People didn't have any cash. They got levered, right? And they're out of business. They got bought out by the guy that had cash. They're not going to use that cash, but they're going to borrow money. When interest rates start to move up is when you're going to see capital formation. That's when they're going to start doing, M&E is really going to tick up. And that's where they're going to turn around and they're going to start doing what? They're going to improve their factories, they're going to improve their technologies, because they're still, see, business people are way smarter than government people. Because they're looking at that going, hey, boy, look at my cost of capital. I can really make this thing work. So they turn around and they start investing that money. That's what's going to happen. You're going to get that next leg, and that's where that next leg is going to come from. That's going to be the last leg before we have a downturn. We will have a downturn. There are always going to be downturns. The thing is, people never expect them. They usually happen when you don't expect them. The fact that probably half of this room or more is very pessimistic is really a good thing. It makes me feel very comfortable. If I walk in and everybody's like, yeah, Kurt, you're right, I'd be like, ooh, I'm a little scared. Because generally that's the case, right? If you study the trends, most people are wrong. Because bad news sells copy, all we hear is bad news. Okay. Inflation, this is it right here. Inflation, it's going to be interest rate cycles are 40-year cycles. The last time debt to GDP in the United States got the highest it is today was 1945 after World War II. We're about 120% debt to GDP. We're about there today. Something interesting happened. Interest rates were very low. Why? Government had a lot of debt to service. What else happened in 1945 is the top tax bracket was 94%. Ouch. That was a biggie. Not too many people were in it. Everybody was playing games to get out of it, but they had to do it, right? It stayed high in the tax rates until about the 1980s, and then it went down. Okay, so we're going to have some, but listen, let's go to inflation first. Inflation and interest rate cycles are 40 years. It took 40 years for interest rates to go all the way to a peak in the 1980s. We already talked about why they're not going there now, because we don't have this. Labor unions are only 11% of the U.S. private workforce now. So they're not going to have to pay people. It's just the way it's going to be. And all of a sudden, from the 1980s, it took 4 years for them to come all the way down. What was it coming all the way down? That was a great bull market in bonds. That baby is over. Okay? That doesn't mean bonds are all bad. There's ways you can make money in bonds. But it's over from what we knew. Okay? It's a different arena. So what's that mean as far as the other thing, the 94%? This is a really important deal. There's a great piece I didn't mention to you yet. If you go to the, I tell you, I read this stuff on I get up every morning at 4:30 in the morning, and I go to bed. I fall to bed about 8 o'clock at night, so it's almost bedtime for me. So if I start yawning, if I do fall asleep up here, somebody wake me up, I guess is what I'm asking. The process is in the April 15th, 2010 Newsweek, there was an article titled, "Today is the best tax day of the rest of your life." And it was really something. And it said, it was the Tax Policy Institute. It talked about the size of the government debt, the true size of the debt, not the size of the debt that they print, the 200 trillion. They said in order to cover that debt, everybody's tax rates would have to go up by 50%. If you're in 10, it's going to go to 15. At that time, it was 35. If you're at 35, it's going to go to 52. That's probably not very palatable. However, if you just raise the tax rates in the top two tax brackets, those tax brackets are going to go to 88% and 91% respectively, and the wealthy will quit investing money, they'll quit taking risk, because they don't want to pay the taxes on that money, and why would you? So we got a problem. It's got to be taken care of. If you have IRAs and 401ks, those types of things, I can show you how to pass those things to your family tax-free. But man, I'm telling you, I've done a ton of Roth conversions. Tons, some 7 figures for people. Because the principle behind, I don't even do them, I'm all tax-free in everything I do. I don't have anything tax-deductible anymore. I look at the trend where tax rates are now and where they're going, where they have to go. It doesn't make any sense to put money in at a lower tax rate and take it out at a higher tax rate. Doesn't make any sense. Because you lose all your deductions, your house is paid for, your kids are gone, you're going to be in a higher tax bracket. There's ways to get around that, you just got to plan for it. So I think inflation and taxes are going to be a big thing. Gold, I always get the gold bugs. You don't get those much anymore. This number right here is the inflation-adjusted price of gold. What that means is gold hit a peak in the 1980s. I can't remember the exact number. I believe it was about 850 bucks. Then it crashed and stayed down all the way through until it climbed up here recently, December 2013, to 1,200 bucks. But if you did an inflation-adjusted price of gold, in other words, what it really should be, it should be priced at about 2,600 bucks an ounce. It isn't even increased at half the rate of inflation. Gold is only good if everything falls apart. It's okay to have 5 or 10% of your portfolio in gold, I understand that. But we're not falling apart. We're going to be expanding. So it's a time period to where we've got to understand what we have and what we take place. We're going to go past this. You know, Affordable Care Act, that's such a political hotbed. I'm not going to talk much about it. It's going to be law. It is law. It's good or bad, I don't know. I think it could lead to the next downturn. The reason I say that, it'll be about 2016. I try to look at things that might cause an issue. We don't know what the true participation rate of the true cost is. I mean, we don't know yet. We won't know how many young people are in on it. That's the key. We don't know really what the premiums are going. Personally, I was affected by it because my wife has multiple sclerosis. So let me see, I was paying $1,600 a month for a $2,500 deductible, and her MS drugs were 70 bucks a month copay. Now I have a $10,000 family deductible. I have to meet a $5,000 medical copay for her MS drugs a year. And my premium is $1,600 bucks. I'm told I'm better off. I can't figure it out yet how, but I'm told I'm better off. Some people are better off, and I'm not making light of that. They are better off, and that's a good thing. So I think when we really fit and hit those costs of what the true cost of that program might be, it might be a bit shocking when they have to calculate the premiums, and that might actually be the downturn. But here's my thought on that: there's so much cash. Where else are people going to put money? Where else are you going to go? Interest rates are going to be low for a long time. Bonds are not going to be very attractive for a long time. You can only own so much real estate. When that thing corrects, all those people that are sitting in cash, all these people in this room right here that are waiting for that 20% correction, because usually we have 3 5% corrections in a year, one 10, one 15% every 2 years, and one 20% every 3 years. We had an 8% correction in January. It was the single biggest outflow of equity mutual funds to bond funds in the history of the U.S. market. An 8% correction. You think people are a little trigger happy? When that happens, what's going to happen? The market goes down. What are people going to do? They got cash. They're going to buy it. It's going to go the other direction. We're just not through this cycle yet. It's riskier today, no question, than it was before. I might have some stops on portfolios, things like that. All right, what do we think on a forecasting? This was actually early in the year, but it's interesting because to look at. The sunny forecast, interest rates are going to stay low, U.S. housing will continue to improve, and the global economic growth will go. If I'm looking for places that there might be some value, I'd probably start looking at Europe. I'd probably look at the emerging world. I'm actually looking there because we're putting client money there. Because I think there's opportunities to make some money. They're behind us in the economic recovery, right? We're still looking good, but they're behind us. A little more risk, of course, when you do that. But some real opportunities. What's sort of partly cloudy: credit, inflation, U.S. politics. I love this one. Nothing's going to happen. Nothing's going to happen. I'm really tired, and I'm saying with both parties, I just want somebody to tell me the truth. I'm smart enough. I get insulted every day when I turn on the TV and I listen to these commercials or hear of somebody running for election or re-election talk, because they're lying. They all, every one of them. Well, I realize I stand for nothing by saying this. Everybody who's running for re-election shouldn't be re-elected. What a message that would send Washington. Huh? That would really send a clear message. We should move Washington, D.C. to Topeka, Kansas or Des Moines, Iowa. Heck, we can get pickup trucks and tractors. We can circle the doggone place. They can't get out of town until they get business done. I mean, they've lost who they work for. And it really upsets me. But nothing's going to happen this year. Why? Because nobody wants to do anything. Nobody wants to make a decision. Believe it or not, gridlock is great for the economy. Economies do the worst, the markets do the worst when it's all Republican or all Democrat. Things change too fast. How I explain this to the average person is this. If you're playing Monopoly, and every time you roll the dice, the banker changes the rules, you ain't buying nothing. You're sitting on your cash. You're not going to buy Park Place. You're not going to buy a railroad because you know what the rules are going to be the next turn. Economies fall down when that happens. So the election this year could be relatively important, right? If we stay gridlocked, everybody's like, oh, nothing's going to get done. I'm like, nothing's going to get done. So you got to be aware of how that plays out. So politics is a kind of a deal. Consumers coming back. I saw a deal the other day I didn't believe. They said that consumers are actually the highest cash levels since the 1970s. That's a bullish signal, right? When consumers have cash. Wow. When businesses have cash. Equity valuations. I got a thing from JP Morgan right here. I was speaking to my young friend Nate, the other guy, Justin. By the way, this is Nate Chapman. Nate's an intern with me this year. I got a couple interns. Nate Chapman and Nathan Rindles. Nathan's at a place college basketball, so he's at a basketball camp. Nate's a finance major at Kansas State University. Wants to enter into the finance world in some way. He's a really bright kid. If you guys ever have a job, remember his name. He's a wonderful kid. Okay, next. The evaluations, where do my glasses go? You ever put the glasses on your head and you spend the next 20 minutes looking for them? My staff, they're all in their 30s and 40s, and they tell me they never want to work anywhere else again. They want their job with me to be the last job they ever have, which is very much a compliment. But I think it's because I amuse them every day. Oh, I'll get it for you. Yes, sir. It's the cyclical slowdown in the emerging markets. That's the risk. Geopolitics, that's a little bit of a risk right now. Once you see geopolitical politics. But I kind of like it a little bit because it's not really affecting us. As long as we don't shoot ourselves in the foot, we're going to be energy independent by 2020. There's a great piece, by the way, if you want to read something. I don't know how I find all these things and how I married the most beautiful woman, 52-year-old woman. She's not 52 yet. Sorry, honey, you're 51 till next month. They're in the state of Colorado. She says multiple sclerosis. She's raised 3 kids. She puts up with me. She's incredible. I'm a very fortunate man. We love each other more today than we did got married. It's a great thing. I also want to remind you this is being filmed. She'll see this. So, but what we want to, where was I going before I got off my track here? JP Morgan. JP Morgan did a chart and said right now stocks are about 16.5 PE. The average on the high side PE, X the tech bubble, because that kind of skews the norms, was 18.4, and on the low side average is 13.3. So we're not cheap, but we're not expensive. Jeremy Siegel makes a pretty interesting argument. He says compared to bond yields, you could make an argument that PEs can go into the 20s. I'm a little uncomfortable with PEs in the 20s, but that's what he says. And he's been pretty right. So interesting stuff. Okay, what do we got here? History lesson. This chart really means nothing, but it's up there anyway, so we'll talk about it. Whenever the market is up 20% for a year, the following year, 64% of the time it goes up. The average, 7.4%. All years other than the market gains more than 20%, 65% of the time it's up, 7.2. Whenever the market is up for the year, it's 65% of the time, it's 8.4% average return. And all years since 1890, the market's averaged 65% of the time it's been up, and it's averaged 7.2. What does that mean? It just means the market's probably going up.